Hello, everybody. Welcome to our Small Business Finance Hub Money Clinic. So, some of you guys may be wondering, what in the world is this Small Business Finance Hub? Well, this past week, Carolyn, San Francisco had a business expo here in California. And Jay Lee, there was over 5,000 people, business owners, at this expo. And we met at least 200 people at our booth, Small Business Finance Hub. And there was such an overwhelming, wanting to know about our services that we said, you know what, let's have some small workshops throughout the week so that people kind of see, what exactly does the Small Business Finance Hub do? And what do we do with you guys? We are a resource to small business owners just like you. So if any of you guys were at the actual expo last Wednesday, put a 1 in the chat, because I want to see, is anybody here from the expo? Because people that came from the expo, we have a special prize for them. But, you guys, I've been on phone calls and Zooms back to back all week long to help our small business owners. And they expressed that they wanted to know more about, tax strategies. They wanted to know more about retirement planning. They wanted to hear more about living benefits. So you guys, this week, we put together our small business money clinic workshop just for you. Now, you guys, yesterday we heard from Christian Kim, who shared with us some tax strategies for business owners. And today, I think the most popular category on the survey was this, Jay Lee, retirement. As a business owner, what are my options for retirement? So you guys, I brought out the big guns, Carolyn. I said, who can I call that will specialize in small business owners' retirement? And you guys, I got him. And it is the one of you guys, Mr. Jay Lee. So Mr. Jay Lee, welcome. We thank you for being on, you guys, at such short notice, but we appreciate you. So I'm going to hand it over you guys right to our guest speaker, you guys, Jay Lee, to talk about retirement planning for small business owners. Thank you, Jay Lee.
Thank you, Wavette. Thank you for having me. Hello, everyone. I hope your evenings are going great for all of you. So today I was invited to share some information on how to prepare for your retirement. Especially for the small business owners or self-employed, for that matters. There are a lot of people who does own a business by themselves, right? Sole proprietors or small business owners or maybe family-oriented businesses and whatnot. Those are the backbone of our country, right? So we're all entrepreneur type of people that drives this economy. So one thing that I want to emphasize before I dive into my topic today is that, let me share the screen first. So one thing that I want to point out before I even introduce some of the retirement plans available for self-employed or small business owners and whatnot. I want you to understand the background of our country's retirement plans, right? So, there are certain type of retirement plans that certain individuals or business owners could take place. All of them are considered to be qualified plan. Qualified plan simply means the IRS recognized that plan as a tax advantaged account. Okay, so some of you already know those qualified plans, and some of you may not know. So that's why I want to take time to go over this background of our retirement world, right? As you heard, there are so many things that you hear from Social Security system is not working great lately, and you hear stories Social Security will not be available in about 9 or 10 years, right? I came across this article that was issued by the Social Security Administration Office last week. They said that they projected that their Social Security funds will be depleted in 2035, but they had to now move that year 1 year forward. So they are now expecting that Social Security funds will be totally depleted in year 2034. That's 9 years from today. And then the old age security, the Social Security retirement benefit that we receive will be depleted in 2033, in about 8 years. So that's what's going on with the Social Security. So Social Security alone is not going to take care of the retirement for, many of us here tonight. So the whole purpose of the IRS encouraging the individual or the business owners to set up their own plans, right? So they want to roll out like 401ks and IRAs, IRAs, SEP IRAs, Roth, and et cetera. So back in 1974, the federal government came up with the act. It's called the ERISA, and then they roll out a 401k plans and IRA plans available for all of us to take advantage of. Okay, so there are only two. You have to choose one of these two. Either you take the pre-tax contributions, like before tax, right? You take the before tax contribution and you get tax deductible on your contribution, but you have to pay taxes on your distribution, right? So you have to pay taxes when you take the money out. That's what we call traditional IRA. Or you can do a Roth type of an IRA, which you take after tax contribution, which you don't get any tax deductions, right? No tax write-offs, but you get tax-free income in the end, right? So it's the order is, kind of reversed. So you can either take this or versus this one. So those are the main benefits of IRA accounts or retirement accounts or whatnot, okay? Now, the problem is if you're self-employed or small business owners, right? Unfortunately, these group of people, you guys are the hardest workers, right? Probably you work the hardest, but you maybe at a group, that least group of retirement plans or welfare benefits available for you guys. Just because you own your own business and self-employed and whatnots, you don't get any group benefits that is, empowered by your employers, right? You don't get any group plans or any 401k plans or pensions for that matter. So, you probably work the most amount of hours, you work the hardest, but you get least amount of benefits. Do you all agree with that? Right? So that's a problem, right? So the business owners are as far as to me is the worst group of people when it comes down to retirement plans, right? Simply because you don't get any employer sponsored programs. So most of you, if you own a business, you may be a sole proprietor, you work for yourself, or you do have some type of a business composition of LLC, or you may have an S corporation, right? Many small business owners do have an S corporation type of the business entity because it gives you most tax advantage benefits, so to speak. I'll go into that a little bit more details later on. So because you work for yourself or because you own your own business, you may need more deductions for your business, right? Meaning like you may need your more tax write-offs. Simply, if you set up a individual retirement accounts, it's not enough, right? You can only get up to like $7,000 or $8,000 if you're over 50 plus years old. So that contribution limit may not be sufficient to start preparing for your retirement age. It's simply because you don't get any, again, employer-sponsored retirement plans like 401ks or pensions and whatnot. That makes sense, right? So that's why you may want to use a special type of retirement account called the SEP IRAs, right? SEP IRAs or solo 401k. These are the two plans that I want to introduce to yourself, especially available for small business owners or self-employed individuals. Okay? So let's dive into SEP IRAs. Okay. It's called the Simplified Employee Pension. Okay. Just like when you see in these the title, Simplified Employee Pension, it looked like a pension plan, right? But it's a lot simple to set it up. It's very easy to set it up. Any self-employed or any small business owner can set up this account with simply just completing the IRS form. I think it's a 5305 form. So simply, complete the form and you can set up your SEP IRA, Simplified Employee Pension Program for your own business. That's very easy to set it up. Not only that, you can contribute up to 25% of your compensation in any given years. Okay. But you're going to be capped out maximum of 70,000 in 2025 this year. Okay. So let's say your compensation is 300,000, right? 25% of that is 75 grand, right? So because of the maximum cap of 70,000, you'll be capped out at 70. Okay. Anything less than 70,000, you can contribute up to 25% of your compensation. Okay. So right out the gate, you can see the total contribution amount is a lot higher than the individual retirement accounts. Does that make sense? Right. So you can literally put 70 grand into this plan and then you can have this money grow tax free, tax deferred, right? And then you can access these funds just like a regular IRA or pension accounts. Okay. But there is a caveat. If you have an employee who worked for you for more than 3 years, okay, the IRS says technically 3 out of the most recent 5 years. If you have an employee that worked more than 3 years, you have to include them in this plan. What I mean by that, let's say you as an owner decided to put 25% of your compensation to your own, SEP IRA accounts. Let's say you have, qualified employee, right? Then you're going to have to include that employee and then start funding that 25%, whatever the percentage that you decided for your own account that has to go into their account. All right. So that's a caveat. I mean, that's, I guess, a disadvantage. So this program works the best if you don't have a full-time employee that worked for you 3 years, right? If you have a bunch of part-time employees and, people who just work for a couple of years, that should be definitely perfect fit for you. Because in that case, you can just set up the account and then contribute it to your own account only because you don't have to include those employees. Okay, make sense? And then I want you to understand when you have the retirement plan, so to speak. Let's say you have a 401k plan, right? Let's say you work for a certain company that offers 401k plans. 401k plans, they have two components. There is an employer contribution, and then there is an employee elective. Employee elective is that you decide as an employee that you decide how much money you want to contribute to, right? Because this SEP IRA is only an employer plan, you don't have that employee elective contribution available. So everything, it has to be funded by the employer, which means you, right? So that's why if you have to pay attention to these restrictions, right? If you have employee work more than 3 years, then you're going to have to include them in the plan, and then you're going to have to start contributing to their own SEP IRA account for their retirement monies. Okay, so that's something that you want to pay attention to. So let's do a case study. Let's say there's a family-owned business. There's a lot of people who run their business, husband and wife. And I just met a person who owned a franchise, but they're owned by husband and wife. And luckily, all their employees are part-time employees, and they don't have a qualified employees, right? They don't have a 3-year plus employee. So that's a good thing. So they decided to do SEP IRA. So both take $60,000 W-2 income from the business. So you have to understand how your business is incorporated, right? If your business is incorporated as corporation, that means you're going to take W-2 income from your business, right? If you own a business by like LLC or any type of sole proprietorship or whatnot, you can't do this. Okay, so there's a different ways to funding the SEP or IRA accounts. So anyways, in this case, they own a business by S corporations, and then they take 60,000 annually from the business, each husband and wife. So because they can contribute up to 25% of their, compensation. So 25% of 60 grand is 15,000, right? So for $15,000 for husband, another 15,000 for wife. So they both can contribute to their SEP IRA individually, right? Because they both have a earned compensation, right? So in this scenario, husband and wife combined, they can put 30,000 a year into the SEP IRA account. Okay, and they don't have to include their employees to the plan. Okay, so certainly you see that it's very cost effective. You don't have to hire the accountants or bookkeeper to do like a salary contribution deferrals, whatnot. So this is very simple, easy to set up, and then with that money, every year going in 30 grand, you don't have to do 25% of your compensation. You can do 20%, 10%, 5%, or 0%, however you want to do it, depending on the situation each and every year. So you can initially set up a 25% of compensation for the first year, and then I see a lot of people then never contributed again and just left it there, right? That's not what you want. You want to consistently put money into this account, right? Right? Because you want to add more money and you want to grow your money. Now, with that money, that could go into any type of investment. You can invest in individual stocks. You can invest in mutual funds or exchange traded funds, or you can even invest in life annuities, life insurance products and whatnot. So, depending on what your risk tolerance or preferences, you can pick and choose whatever the investment option is that you think is best for you. All right. Okay. Now let's dive into solo 401k. I believe this is much more attractive than SEP IRA. Okay. Especially if you're self-employed or you're a married couple and you own a business, just between you and your, spouse. Right. The reason why solo 401k is very attractive is you can literally contribute up to 100,000 or more in a year into this plan. Okay, SEP IRAs, the maximum you can put is 70,000 for the most part. If you qualify, you can put up to more than $100,000 per year into your retirement accounts. Okay. I think this is very powerful because, like I said, business owners don't have the group plans or employer-sponsored 401ks and whatnot. And this literally could get you to a position where you can have a lot of money available once you retire. So how it works is let me take that back. So with the SEP IRA, you could only do an employer contribution part. There's no employee electives available. But with the solo 401k, you can contribute as an employer and also an employee, both, right? You can do both because you're the owner and you're also an employee for the business, right? So you can do both employer contribution plus employee electives. So the way it works is that an employer, as we learn from SEP IRA, you can put 25%, up to 25% of your compensation in every year, up to 70,000, right? And then in addition to your employer contribution, you can put employee deferral up to 23,500 in year 2025. So if you add these two together, that's a 93,500. But if you're over 50 years old, you can put 31,000 instead of 23,500. So you can put 31,000 for a 50 plus year old. If you're aged between 60 and 63, you can put up to 34,500. So if you combine these two, you can go over $100,000 in 1 year. You can max out. The only thing is, do you have that cash flow, right? If you have a good cash flow, if you have a very successful business, and then your cash flow is really doing great, definitely this is the plan that you want to take advantage of. Okay. So because this is a solo 401k, you can work this thing as like an employer sponsor 401k plan. So you can take a loan against your own balance. You can take advantage of a hardship withdrawals, because this is a qualified plans. The IRS will limit the access of getting fund out of your account unless you have the hardships, you have a dire situation, you have a sickness, or if you buy a home for a first-time home for purchase or whatnot. There are certain categories that you can qualify, and you don't have to pay early withdrawal penalties, and you can qualify for that. With the SEP IRA, you can't do this. With the solo 401k, you can take advantage of these options. So again, I came across this very successful business owners, owns a S corporations. They both, husband and wife, take W-2 income from the business. Their husband takes $250,000. Wife takes about $130,000. Their age is 55 and then 48 for wife. So husband literally, right, maximum, he can take 25% of his compensation, which is $62,500, plus the employee deferral, which is $31,000. So husband could max out at $93,500 to the solo 401k, and then the wife, she can take 25% of her compensation, which is $130,000, so $32,500 plus $23,500 because she's under 50-year-old. So she can max out at $56,000. So between both husband and wife, they can put up almost $150,000 in 1 year. Right? Isn't that amazing? Right? Like, again, you can pick and choose which investment options you think is best for you, right? But I want you to realize that depending on how you incorporated your business, some of you have S corporations, some of you have LLC, some of you have, I don't know, C corporations, some of you have sole proprietor. You have to know that being a sole proprietor, the one-man business person, is, when it comes to the taxation, is the worst category that you could ever be in. Here's how. If you make 100,000 gross income as a one person sole proprietor, or if you're a licensed professional, like if you're like a real estate agents, or real estate is successful real estate agent, they own LLCs or they own S corporations or sole proprietor or whatever. Right out the gate, you're going to have to pay 15.3% self-employment tax just for being a self-employed. So if your gross income is 100,000, you're going to be taxed at 15,300 right out the door, because you, self-employed person, are not an employee, but you are not an employer, but you are both employer and employee. So you're responsible to pay both employer Social Security tax and employee Social Security tax. Okay, so I'm not going to get into these taxation too much. Okay, I don't want to confuse you. But anyways, so you're asked to pay 15.3% self-employment tax. Okay, because you don't have an employer who pays the half of your Medicare tax or Social Security tax. So you're asked to pay both employer and employee portions of, we call it FICA, FICA, the Social Security tax. Okay. Now you get to take that gross income, and then you're going to use Schedule C. Schedule C meaning like your cost expenses, like, your operating expenses such as vehicles, office equipments, or if you're a retail business owners, you can take off your cost of goods, right? All of that you take away as an expense, and whatever is left over is going to move to the 1040 form, and then you're gonna have to file taxes, individual taxes on it. right? I'm not telling you how to do filing your taxes for the business, but I'm telling you this is an inefficient way or least advantageous way when it comes to paying taxes. Because paying taxes could be number one obstacles as a business owner. So I want you to look into your business, how your business is incorporate and how your business is paying taxes. Okay. Like I said, I'm not a tax advisor, tax accountant, and whatnot, but I'm not here to give you any tax advices. But it's very important to understand how you get paid taxes on how you're going to get more deductions for your business. Not only preparing for your retirements, it is very important, but if you don't have enough money available for, for saving for your retirement, it's not going to work out. So I want you to understand, depending on how you set it up and depending on what plans you set it up for your retirement accounts, you can either put away 7,000 or 25,000 or even 43,000, depending on how you want to file your taxes or how you want to set up your retirement plans and whatnot. I know there's a lot of information. I went really quick because it's only 30 minutes I was asked to do. It's impossible to really paint the whole pictures of how you can take advantage of these retirement plans available for your businesses. Each and every one of you are different. So if you have any questions or you want to really consult for your own situations or whatnot, please don't be shy and please let your whoever invited you today, let them know that you want to sit down with one of us and then go through the entire picture of your retirement accounts or whatnot. We can definitely help you out. Okay.